Hey, it's Joe, and this is the 7th installment in the Quant Trading and Futures video series. Today we'll be discussing portfolio optimization. So last time we discussed parameter optimization and the different searches you could use in order to select which parameter sets you want to test. And by test a parameter set, we mean generate the return series for that parameter set. So now that we've generated return series for these parameter sets, how do we combine them to create the strategy portfolio? So before moving forward, we're going to talk a lot about training and testing in this video. So if you need to go back and review the overfitting video where we discuss the importance of out-of-sample testing, how to use the rolling window, and how it's one of the best methods for avoiding overfitting, you should go back and do that now. But moving on, for each parameter set I in 1 to n, let Ri train and Ri test be the return series for the parameter set over the training and testing periods respectively, and let Wi be the weight assigned to that particular parameter set. The training return series R1 train through Rn train are used to compute the weights W1, Wn with the goal of maximizing the portfolio's Sharpe ratio over the testing period. So mathematically here we have another multivariate optimization problem. We want to choose the weights W1 to Wn in order to maximize S of W1 R1 test plus all the way through to Wn Rn test, subject to the constraints that the sum of the weights is equal to 1 and that each individual weight is non-negative. So essentially what we're doing is we're taking a linear combination of the returns series and we're trying to select the weights in order to maximize the Sharpe ratio out of sample over the testing period of that linear combination. But before we discuss different solutions to this optimization problem, we're going to discuss how you determine which parameter sets to keep and which parameter sets to throw away. So in general, we're going to want to keep parameter sets whose return series have high training Sharpes. Now there's a few ways we can do this. We can take all parameter sets that have Sharpes above some Sharpe threshold. Maybe take all the parameter sets with Sharpes above 0.5. We could take a fixed number of parameter sets. Maybe we take the top 100. Or we could take a percentage of all parameter sets tested. Maybe the top 1%, maybe the top 5%. And there is no overarching best method of how to do this. It's really determined by the details of the strategy. So for some strategies, it's infeasible to trade more than a certain number of parameter sets. So in that case, you'll want to take a fixed number. And in other cases, you might want to subject them to a Sharpe threshold or take a percentage of all parameter sets tested. But ultimately, this is strategy specific. And why do we want parameter sets that have high Sharpe ratios? Well, there's a couple reasons. One is that the Sharpe ratio is arguably the best measure of risk-adjusted returns. The goal of any trading strategy is to maximize risk-adjusted returns. And so it makes sense to select parameter sets that have high Sharpe ratios. But the other reason is that statistically, the Sharpe ratio is the t-statistic of the hypothesis test that the expected return is positive. So high Sharpe ratios imply greater significance. So you can think about this, that if a parameter set has a high training Sharpe, then there's a greater chance that the expected return, the true expected return of that parameter set is positive, and so we'll have a positive return over the testing period. Alright, so now that we've determined which parameter sets to keep and which parameter sets to throw away, let's get back to the optimization problem. So is there a Sharpe maximization solution? And theoretically, the answer is yes. Harry Markowitz, the father of modern portfolio theory, created a procedure for finding this maximum Sharpe portfolio. And Markowitz did go on to win a Nobel Prize for his efforts here. His model is theoretically correct if the expected returns and the covariance matrix are accurately forecasted. Unfortunately, the model is unrealistic to implement in practice. It is overly sensitive to forecasted inputs, and the returns in particular are very unpredictable. It is almost impossible to accurately forecast the returns of a parameter set. And for that reason, Markowitz's solution is of little practical value to us. Instead, we adopt a risk-parity approach. That means that we allocate an equal amount of risk to each parameter set. Risk is a function of volatility and correlation to the other parameter sets, and volatility and correlation are a lot more predictable than returns. So remember, the big issue with Markowitz was that it was impossible to accurately forecast the returns. And while we can't with 100% accuracy forecast the volatility and the correlation, we can get much better estimates for volatility and correlation than we can for returns. Sharpe ratio, of course, uses the returns in its calculation. And while the Sharpe ratio is used in selecting parameter sets, it is ignored in their weighting. We use the training Sharpe as a simple pass-fail tool. Either the Sharpe ratio over the training period is high enough and we keep it, or it's not high enough, we throw it away. And finally, the risk parity weights can be computed numerically using quadratic programming. and we'll go through that calculation now. So let C be the covariance matrix of the return series over the training period. So C equals covariance of R1 train through Rn train, and let W be the vector of weights. So W equals W1 through Wn. Let capital Ri be the risk contribution of return series Ri train to the portfolio. Capital Ri is the increase in the volatility of the portfolio coming from Ri train. And capital Ri is computed via the formula capital Ri equals Wi times Cwi all over the square root of W times C times the transpose of W. And the objective here is to choose weights W1 through Wn such that all Ri are the same. Mathematically, that means choose W1 through Wn to minimize the sum of square differences of the risk contributions of different parameter sets. Again, subject to the constraint that the sum of the weights equals to 1 and each individual weight is non-negative. And there is a well-known solution to this optimization problem using quadratic programming, so you don't have to resort to the searches we discussed in the last video. So we use risk parity to compute the weights we assign to each parameter set, but we do sometimes go back and adjust those weights for reasons of liquidity. So if two markets are strongly correlated, we're going to shift weight to the more liquid market. This is done to decrease our transaction costs. Trading the more liquid market means we'll have less slippage on our trades. And because of the strong correlation, this is going to have little to no impact on our risk. So as an example, let's say the risk parity weights, say we should be trading 10% in the S&P 500 and 10% in the Dow. Because S&P 500 futures are much more liquid than Dow futures, and because they're very strongly correlated, we might shift the weights to be 15% in the S&P 500 and just 5% in the Dow. And this is done discretionarily. There's no formula for doing this, but the big idea is that if they're very strongly correlated, adjusting the weights isn't really going to change the risk, but it will for sure decrease our transaction costs, so it's worth doing. All right, so that will conclude our discussion of portfolio optimization in terms of allocating weight to parameter sets for a given strategy. Now we're going to discuss how you create a portfolio of many strategies. So first of all, for reasons of diversification, we want to trade many strategies. Same reason as before, we don't want to have all our risk tied up in one particular strategy, because if that one particular strategy goes through a rough period, we're going to be in a lot of trouble. So the idea is we want to allocate weight to other strategies. We do that by looking at the out-of-sample Sharpe ratio of other strategies. That will be the Sharpe ratio across all testing periods. We're not concerned really at all about the in-sample Sharpe ratios in this case. And we want to select strategies who have an out-of-sample Sharpe ratio above some Sharpe threshold. So the other methods of selecting a fixed number of strategies or selecting a percentage of all strategies tested, while they could work for choosing parameter sets for a strategy, they make less sense for choosing which strategies to allocate to a portfolio. And the big question here is how do we assign weight to these strategies once we've selected which strategies we want to trade. I have a visualization here of a pie graph, which is really representative of what our ideal portfolio looks like. So the black bars represent different strategies. So there's 3 different strategies here. The colors red, blue, yellow represent different markets, and the individual wedges represent individual parameter sets. So the idea is we want to trade a portfolio of many different strategies across many different markets, across many different parameter sets. So last time when we were allocating weight to parameter sets for a strategy, we used risk parity. Do we want to use risk parity again when we're allocating weight to strategies within an entire portfolio? And the answer is yes, it is a good starting point, but it's not enough. There's too many other factors when it comes to allocating weight to strategies that weren't there in terms of allocating weight to parameter sets for a given strategy. First of all, the out-of-sample Sharpe ratio for a strategy is a lot more reliable than the in-sample Sharpe ratio for a given parameter set. So the strategy returns shouldn't necessarily be ignored in the weight. Remember, risk parity is totally ignoring the returns. But for out-of-sample Sharpe ratio, it's a lot more robust than in-sample Sharpe ratio, of course. And the strategy is diversified. It trades many different parameter sets. So that's even more reason why that Sharpe ratio would be more reliable than a parameter set that trades just one parameter set. So suppose you have a strategy with a Sharpe that's barely over the threshold, another strategy with a Sharpe that's 3 times that of the first strategy, you probably want to give more weight to the second strategy. Another concern is capacity. Capacity is the maximum capital amount a strategy can trade before the edge decays, determined by things like the number of markets traded and their liquidity. So if a strategy trades just one market and it's not a very liquid market, we're not going to be able to put that much capital into that strategy. The frequency of trading, if a strategy trades very frequently, then we might not be able to put more capital into it because there's just not going to be enough liquidity in the market to trade even more frequently than it already does. And the profit per trade. If the profit per trade is low, and you increase the capital, you might go from 1 tick of slippage to 2, and that might eliminate all the edge. Finally, for capacity, we're also concerned about the minimum amount of capital we have to allocate to the strategy for it to work. Some strategies do have minimums as well. So these capacity and out-of-sample Sharpe, these are things we definitely want to consider when we're allocating weight to strategies in addition to risk parity. And the strategy's live trading performance is another very important factor when determining how much weight to allocate to that strategy. The live trading performance provides a level of confidence. If a strategy has a very high live trading Sharpe, we want to give more weight to it. If it's been trading for a very long time and done reasonably well, we want to give more weight to it. The live trading is really the best test of if a strategy works because there's real money at play here, real profits have been generated from this strategy. With that said, we don't want to give too much weight to the live trading performance because the trading period is much smaller than the trading period for the out-of-sample backtest. If we've only been trading the strategy for a year, even if it had a great year, it is still possible that the strategy just had one lucky year. If we did our backtest correctly, then the out-of-sample results of that backtest will be significant. So it is a balancing act. And in general, strategy allocation is a lot more discretionary than systematic. This is in contrast to much of the other topics we've discussed in this video series that have been a lot more systematic. And while a systematic approach is great, there are some tasks where there's too many factors at play to have a purely systematic approach. And allocating weight to strategies within a portfolio is certainly one of those. So that'll wrap up this video on portfolio optimization. Next time we're going to discuss risk management and position sizing.